Welcome to Illuminati Silver's Inner Sanctum, where we tell you the truth about precious metals, banking, economics, and politics. Today is Monday, the 7th of January 2019, and we're discussing the growing evidence of China's slowing economy, shadow banking system, and what effect these may have on commodities and global growth. China's stock market was the world's worst performer last year, ending with a loss of 28%. This reflected the growing concern over signs of weakening growth amid a background of trade tensions. In addition, we also saw last week Apple advising that slowing sales in China meant it would not meet sales expectations, triggering sharp falls on global stock markets. Now, we will add briefly here, however, that in fairness, Apple has other problems too, such as a perceived saturation of mobile phone technology, with competitors stealing a march, or at the very least reducing Apple's ability to grow further in that area. As one commentator remarked, "Who wants to pay over $1,000 for a phone every year?" That said, there have also been a string of other companies which have issued warnings recently over China's slowdown and the impact of the trade war with the US. The most noteworthy are a number of car makers, including Ford, General Motors, and Chrysler, plus Jaguar and Land Rover at the luxury end of the market. Now, to put this report in perspective, Nike have said for them the opposite is true, with sales rising some 24% in Greater China. So let's take a little look at the underlying economic figures. Now, we do so with the caveat that we all know governments generally massage their figures, but on the whole can only do so now and again, and this is why we look at trends rather than just a month's figure in isolation. China's economic growth has been slowing in recent years and is now running at 6.5% annually, and forecast to be around 6% in 2019. Still impressive compared with other countries such as the UK with 1.5% GDP over the past 12 months and the US with a little over 3%, and expected to fall back to 2.5% in 2019. However, those of us who have been watching China for many years will know that 6% is about half the average growth rate it has tended to manage over the last 20 years or so. Of course, nothing can rise forever, but with China being the second largest economy in the world, with the US still just hanging in there as number one, it is nevertheless quite worrying that its growth rate is on a downward trend line, and especially as the latest batch of economic news suggests this slowdown is deepening, and of course made worse by the trade war with the United States. So what is the data to which we refer? Well, we saw last week that manufacturing activity contracted for the first time in 19 months. New orders have fallen and retail sales eased. Firms have also reported softer demand despite some discounting. But we have an even greater concern for China longer term than even this. China has a possibly systemic problem with its complex and some say shady shadow banking system of unregulated lenders or unregulated financial products. Shadow banking refers to lending and credit intermediation outside of the typical banking system without the usual protections of regulation. These particularly include so-called entrusted loans and undiscounted bankers' acceptances. One of the major concerns about the growth of China's shadow banking system is that risk is more difficult to detect because financial institutions invent new instruments, such as the aforementioned entrusted loans, which are off-balance sheet assets, which hides the added risk that banks have taken on. We only have to cast our thoughts back to 2007, 2008, where similar type of instruments were used in the creation of mortgage-backed securities and a multitude of creative derivative products, and we are all aware of how badly that ended. However, we have to ask the question, why has this system developed in the first place? Debt accumulation has played a big role in China's investment-led growth strategy, and the traditional regulated banking sector did not satisfy the level of demand for finance that entrepreneurs and developers required. China witnessed an enormous accumulation, for example, of peer-to-peer lending as part of this shadow banking system, and aware of this rise in deregulated lending activity and concern about the range of products being financed with, in some cases, unaccountable monies or suspicious sources of capital, China decided to crack down on this sector. Earlier this year witnessed a wave of defaults, and this 1.3 trillion renminbi or $190 billion peer-to-peer lending industry saw investors withdrawing funds and platforms collapsing. Deleveraging is now the buzzword in China. However, deleveraging will put deflationary pressure on China's economy. This is politically unpalatable, given the pressure to maintain economic growth. To give an historic context of how this could affect the world as a whole, at the turn of the century, China accounted for about 7% of global economic activity. This year, the figure is likely to be 19%, not to mention its close integration with supply chains and how many of these could be further affected. Half of all the world's steel, copper, coal, and cement goes to China, as well as about half of the world's pork output and a third of its rice. So it goes without saying that if China ceases to buy, or more likely reduces its purchases, prices of these items will inevitably fall, and one can only guess the effect this will have on farmers, miners, and suppliers. So the situation is perilous, but equally must not be overstated either. No one is seriously saying that China's economy is about to collapse. Well, perhaps the pumpers are because they want you to buy their gold now. But no serious banker, economist, or industrialist is saying that. But they are becoming increasingly aware that perhaps the boom times are over. They can now expect lower levels of demand from China and lower GDP figures, all of which will provide a downward pressure on global growth, unless, of course, it can be substituted elsewhere. The Chinese authorities are tackling this demise by spending more on infrastructure to spur demand and have been cutting interest rates. You may ask, why are we raising this issue, and to what extent does it have a direct correlation with gold and silver? Well, China being a major importer of both metals, any decline in its economic or financial fortunes will have an impact. It may not be today or even next month, but we must all watch closely these various aspects and influences, as each one, in their own way, will chip at the China growth statue, which could create a far from favorable effigy for the rest of us in the not too distant future. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we're not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.